So what we're looking at today is a compelling analysis report arguing that supermicrocomputer, SMCI, is presenting an ultimate entry opportunity right near its 52-week lows.
It's a tremendously strong thesis, and it's underpinned by some really solid financial data. But to maximize the impact of this report, I think we have to align the presentation with the rigor of that data.
Okay.
The highly charged, almost contrarian tone, it kind of risks diluting the report's powerful fundamental case.
Right, let's zero in on that. That opening hook is very aggressive. It's demanding the reader, stop panic selling, put the phone down.
Yeah, framing it as the sale of the year.
Exactly. That high energy, emotional urgency, it contrasts so sharply with the very calculated PE analysis that comes right after it.
It does. You're comparing a 23x PE to peers that are trading at 40x, 50x, even 100x.
And that juxtaposition, that's the central weakness you're pointing to.
That's it. The reliance on this sort of breathless contrarianism, the classic buy when others are fearful. It just feels misplaced here.
Okay.
If you are presenting institutional-grade financial analysis, which this report clearly is doing, that emotional framing can actually diminish the credibility of the rational argument you're trying to make.
It's like, why would a trade based on a 23x PE need the urgency of a closing time auction?
Exactly. The math should speak for itself.
I do understand the disconnect. It feels like using a megaphone to announce a very subtle arbitrage opportunity. But, in the current environment, especially with the volatility around AI stocks, doesn't some of that high energy serve as a filter to pull the investor away from all the noise?
That's a critical question, and we're not suggesting neutralizing the tone entirely.
Okay.
It's more about recalibrating it, moving from that emotional urgency to, let's say, rational conviction. The goal is to attract the investor who reads 10Ks, not the one who's just scrolling Twitter.
So you let the data itself create the urgency.
Let the data create the gravity. The objective valuation numbers, the PE, the forward PE estimates, that's what should be creating the urgency. Frame the opportunity as a logical arbitrage, a predictable repricing, not as a fearful dip buy.
Right. So we want a tone that mirrors the institutional smart money that the report itself claims is loading up on the stock. Calm, analytical.
And supremely confident in the underlying math.
So how does that translate into the initial framing of the piece?
It means you lead with the mathematical absurdity, not the market fear. So for a concrete example, instead of titling the entry the ultimate entry driven by panic,
You reframe it.
reframe it as something like the rational repricing, which is driven by misaligned market expectations after Q1.
I see. So you'd transition immediately from the low stock price, that $29.37 area.
Directly into the sheer force of the forward P, which is what, roughly 12x based on 2026 estimates?
And by starting with, this price is mathematically irrational, you're instantly appealing to that sophisticated investor's desire for deep value. You bypass the emotion completely.
You're saying the market is wrong, and here is the hard math proving it. Lead with the arbitrage, not the adrenaline. That one switch elevates the entire analysis report.
It moves it from just a compelling trade idea to a robust, institutionally viable investment thesis.
The data is strong enough? You just have to let it do the heavy lifting.
That's a really clean transition. Okay, let's pivot now to optimizing the structural flow, because that's crucial for delivering that conviction right away.
Yes.
The material argues the low valuation is temporary because of an impending catalyst, but the sequencing seems a bit backwards.
It is a powerful structure, but we can make it overwhelmingly strong. The issue is really the placement of the most critical catalyst, what the report calls the missing revenue.
Right.
Where it is right now, it weakens the logical progression of the bull case.
So, as I understand it from the notes, the core argument is that the stock dropped because of that Q1 revenue miss, the $5.02 billion number.
Right, but management was very clear
That the revenue wasn't lost, it was just pushed to Q2 because customers were deliberately waiting
for the newer Blackwell and liquid-cooled servers to become available.
And that Q1 delay is the single, tangible reason for the current slump in valuation.
It is. So the weakness in the report structure is that it presents valuation is dirt cheap, the PE of 23x, before it explains the missing revenue.
So the reader is forced to accept the anomaly first. They're asking, why is it so cheap, without immediately knowing the cause?
Exactly. You're presenting the symptom before you present the diagnosis that, also promises a cure.
Which means the reader is sitting there thinking, okay, 23x is cheap for an AI stock, but maybe there are fundamental problems I don't know about.
To the delayed revenue explanation, they've already internalized a level of skepticism they shouldn't have.
The valuation and the catalyst are, as you said, inextricably linked.
And separating them demands an unnecessary leap of faith from the investor. The suggestion is to integrate that missing revenue reality directly into the valuation argument, establish the temporal nature of the low PE right up front.
So we're basically saying this stock is cheap because of a timing issue that will be resolved next quarter. How does that structural change impact the reader psychologically?
It eliminates that immediate skepticism. Instead of the low PE raising red flags, it becomes a welcome sign that confirms the investor's intuition.
So they think the market missed the forest for the trees here.
They focused only on the Q1 number while ignoring the Q2 forward commentary. It provides the immediate why the stock is mispriced, and it makes the Q2 guidance of $10 to $11 billion feel like a definitive, impending proof point.
Not just a nice forecast.
Not just a forecast, but proof.
I really like how that flips the narrative. You go from defending the valuation to actually celebrating the opportunity. It turns a potential weakness, the Q1 miss, into the strongest part of the thesis.
Absolutely. So, for concrete examples, when the analysis says the market is pricing SMCI like a dying hardware company,
you immediately follow that with the counter-narrative.
Immediately, you explain that this mispricing is temporary and it's caused specifically by customers waiting for those high-margin Blackwell servers. The revenue is already lined up for Q2.
And you present a $10 to $11 billion Q2 guidance as the immediate solution to that irrational PE.
Yes, show that the low PE isn't a structural problem, it's just a short-term accounting lag. And you do that before you move on to the long-term growth metrics, like the fiscal 2026 revenue goal of $36 billion. That sequencing just locks the reader into the bull case from the very first paragraph.
That sequencing makes the argument airtight. It really does. It weaponizes the catalyst right at the beginning. Okay. That brings us to our third major opportunity for improvement, reinforcing the resilience of the argument by really tackling the counter-arguments, the elephant in the room risks.
To enhance the material's overall robustness, the section addressing those core risks needs a much more substantive counter-analysis, not just a simple dismissal. You have to beat the bear case with detailed logic.
And the report does acknowledge two significant risks that are clearly driving that bearish sentiment. First, gross margins dropped significantly, down to about 9.3%.
Right.
And second, there are these ongoing accounting worries related to the new BDO auditor.
Very visible worries.
The material tries to address these by saying margins should stabilize and that the BDO fear is largely priced in.
And that right there is the weakness in a high-conviction report. For a sophisticated analysis, those statements are just insufficient. They read like hopes, not like actual projections.
These two risks are the primary counter-arguments to the ultimate entry thesis. The lack of detail on the mechanism for improvement, it just leaves a major vulnerability. Because if margins fall further, the PE argument collapses. And if the accounting worries persist, the stock just stays permanently discounted.
Exactly.
So we need the underlying financial mechanism, the how and the when, not just the expectation. Let's start with the gross margin collapse, down to 9.3%. Why should investors believe that margin stabilization is a guaranteed outcome?
The suggestion here is to provide a concrete analysis or at least a credible narrative of how these risks are expected to resolve. For margins, instead of just saying they should stabilize, we need to leverage the coming volume ramp.
The Blackwell server ramp.
Yes, we need to discuss how the higher volume expected from that ramp, which is central to the 2026 goal of $36 billion in revenue, is specifically going to influence the cost structure.
Tell me more about that mechanism. I mean, how does volume physically restore the margin percentage in the server business?
Well, it's primarily through scale and fixed cost amortization. As SMCI shifts to mass production of these higher-end liquid-cooled servers, they gain superior pricing power with their component suppliers.
With NVIDIA, for example, or memory manufacturers.
Right, because of dramatically increased order sizes. Furthermore, the fixed costs, the cost associated with retooling for liquid cooling and new assembly lines, those get amortized over a much larger revenue base.
Operational leverage.
It's pure operational leverage, and that's what drives margins back toward a specific supportable historical percentage. The report should really quantify that, say back towards a 12 to 14% range by the time the 2026 growth estimates materialize. That depth demonstrates that the risk is being managed by business fundamentals, not by hope.
That makes sense. It moves the margin argument from wishful thinking to a tangible function of operating leverage. That's much more palatable for financial analysts. Okay, now let's tackle the other elephant, the accounting concerns. The BDO auditor change is a major red flag, and it raises the fear of delisting for some investors.
That fear is real, and it's psychological. So for the accounting worries, we need to add precision around what the de-risking milestone actually is. We can't just say the fear is largely priced in.
We need to define what positive news on filings might actually entail for the smart money.
Exactly. What specific filing milestone is the market watching for to officially move beyond that delisting fear?
What would it be?
It's all about the 10K filing process and the assessment of internal controls. So the key suggestion is to explicitly state that the confirmation of a successful transition to BDO for the upcoming fiscal year 2025 10K.
Or maybe a clean, unqualified opinion on their internal controls.
A clean opinion on internal controls over financial reporting, that would serve as a tangible catalyst. That is the moment the market officially recognizes that accounting risk as mitigated.
So by identifying that specific document, the clean 10K opinion, you transform this ambiguous accounting worry into a measurable, time-bound risk that the analysis has already accounted for.
Precisely. This depth turns a major vulnerability into a well-researched, manageable uncertainty. By demonstrating you fully considered and priced in the resolution of these two core risks.
Margins stabilizing from volume leverage and accounting concerns clearing up after the 10K.
Yes. Once you do that, the credibility of the entire bull case increases, and that low $29 price point then becomes less about panic and more about a short-term technical mispricing opportunity.
This material really does start with a strong valuation angle and clear growth forecasts. These critiques are all focused on optimization and fortification.
The data is excellent. The analysis report is 90% there,